You know that feeling when you're staring at a trading chart, the candles are dancing, the volume is pulsing, the market is moving, and yet, you freeze? You're caught between fear and greed. Do you jump in? Do you wait? Is this a breakout or a fake out? You're not alone. Even the most experienced traders with years of screen time still hesitate in that crucial moment before pulling the trigger. And for flag traders, those who live and breathe quick momentum setups, that moment of indecision can be the difference between catching a life-changing move or watching it run away without you. But what if I told you that your screen already has the tools to cut through that hesitation, to help you see when momentum is real, to give you confidence when everyone else is uncertain, and to show you exactly when to act and when to sit on your hands? The truth is, most traders lose money not because they don't know how to read a chart, but because they don't trust what they're seeing. And that's exactly why today we're diving deep into 3 powerful Thinkorswim indicators that can transform the way you trade flag setups, turning confusion into clarity, hesitation into confidence, and randomness into repeatable edge. So if you're tired of second-guessing yourself, if you're ready to finally understand the story your charts are trying to tell you, then grab your notebook, because by the end of this video, you'll look at flag patterns in a completely new way. Let's start with the truth about flag trading. Flag patterns are one of the most reliable momentum continuation setups in all of technical analysis. They're simple in concept: a strong move up or down, the pole, followed by a brief, tight consolidation, the flag, before price explodes again in the same direction. They show up in every market: stocks, futures, forex, crypto. They're timeless. And yet, despite their simplicity, they're incredibly tricky to trade in real time. Why? Because real charts are messy. Flags aren't textbook perfect, and price action can fake you out, often right before the real move happens. The core challenge for traders isn't spotting a flag. It's knowing when that flag is ready. Too early, and you risk a false breakout. Too late, and the move is gone. That's where the right indicators come in. Thinkorswim, one of the most powerful charting platforms out there, offers hundreds of tools. But buried inside that sea of signals are 3 that, when combined, can give you the clarity you need to stop hesitating and start executing with confidence. Let's break them down, step by step. Not just how they work, but how to use them like a pro. The first indicator, volume profile, the truth behind the price. Every trader looks at price. Fewer traders look at volume, and almost no traders look at where that volume is happening. But if you want to master flag trading, understanding volume isn't optional. It's essential, because flags are all about momentum, and momentum isn't just price moving, it's price moving with participation. The volume profile tool in Thinkorswim shows you exactly where buyers and sellers are most active during a consolidation. It maps out the price levels where the most volume has traded, showing you zones of high interest, areas where institutions are likely accumulating or distributing shares. This is critical because not all flags are created equal. Some are weak, formed by retail noise. Others are strong, formed by heavy institutional positioning. When you spot a flag pattern, pull up your volume profile and look for 2 things. First, are you seeing a clear volume shelf, a horizontal cluster of high volume forming inside the flag? This tells you big players are interested. Second, is the majority of that volume near the top of the flag's range, rather than the bottom? That's a subtle but powerful signal that accumulation is happening, and buyers are preparing for a breakout. When price begins to push above that high-volume area with expanding volume, that's your cue. This isn't just a breakout. It's a breakout backed by institutional muscle, and that's a trade worth taking. The second indicator, moving averages, the invisible trend line. Most traders use moving averages as glorified support and resistance lines, but for flag traders, they're much more than that. They're a roadmap of momentum and timing. Because remember, a flag isn't a reversal, it's a continuation. That means the strongest flags form in the context of a strong existing trend, and moving averages help you see if that context is present. In Thinkorswim, a simple yet powerful setup is to plot the 9 EMA, exponential moving average, and the 20 EMA. These two averages do more than smooth price. They reveal the strength of the trend. When the 9 EMA is above the 20 EMA and both are sloping upward, you're in a strong, bullish environment. In a bearish flag, the opposite holds true. But here's where it gets even more interesting. During a healthy flag consolidation, price often pulls back toward these moving averages without decisively breaking below them. This pullback is the market catching its breath. When price then bounces off the 9 or 20 EMA with renewed momentum, it's a strong sign the trend is resuming. Here's a pro tip. Combine this with the volume profile we discussed. If price pulls back toward the EMAs and finds support near a high-volume shelf, you now have two powerful signals aligning: trend confirmation and institutional support. That's when you stop hesitating and start preparing your entry. The third indicator, Relative Strength Index, RSI, the momentum meter. We've talked about volume, the engine of the move. We've talked about moving averages, the structure of the move. Now let's talk about momentum, the speed of the move. And for that, few tools are more valuable than the Relative Strength Index, or RSI. Most traders think RSI is just about overbought and oversold, but for flag traders, it's about momentum shifts. Here's the truth. Strong trends don't care about overbought readings. In fact, during powerful flag breakouts, RSI often stays elevated for a long time. The mistake beginners make is selling too early just because RSI crosses 70. Instead, use RSI to identify momentum pauses and momentum reaccelerations. During the flag consolidation, RSI typically drifts back toward the neutral 50 level. That's healthy. It shows momentum is cooling off before the next leg. When RSI then turns back up and breaks above 60 as price breaks out, it's a strong confirmation that momentum is returning. Here's a bonus insight. If RSI diverges from price, meaning price makes a new high but RSI doesn't, that's a warning sign. It could mean the breakout lacks real strength. But if RSI is making higher highs along with price, it's a green light. Momentum and price are in sync. And that's exactly what you want before you commit. How these three work together, the confidence triangle. Individually, these indicators are useful. Together, they're transformative. Think of them as three different lenses that, when aligned, give you a crystal clear view of the market. Volume profile shows you where the smart money is positioning. Moving averages show you if the trend structure is healthy. RSI shows you when momentum is returning. When all three align, when you see institutional accumulation on the volume profile, a strong EMA structure supporting price, and RSI turning up from neutral, hesitation disappears. You're no longer guessing. You're trading with confirmation, with structure, and with confidence. A real example. Turning indecision into action. Let's bring this to life with a real-world scenario. Imagine a stock that's just had a huge breakout, a 15% surge on heavy volume. Over the next few days, it starts to drift sideways, forming a classic bull flag. This is where most traders freeze. They see the pattern but don't trust it. They fear a fake-out. You, however, approach it differently. First, you pull up the volume profile. You notice a clear volume shelf forming just below resistance, a sign of accumulation. Second, you check your 9 and 20 EMAs. They're sloping upward and price is consolidating above them. Structure is intact. Third, you glance at RSI. It's cooled from 80 down to 50, and now it's curling back up. On the next trading day, price breaks above the flag's resistance line with a surge in volume. RSI confirms, volume confirms, trend confirms. You enter with conviction. A few days later, the stock is up another 10%. You didn't chase, you didn't hesitate, you waited for your three signals, and when they aligned, you executed with confidence. The psychological advantage. Confidence is a skill. The greatest enemy of the flag trader isn't the market, it's doubt. Doubt leads to hesitation. Hesitation leads to missed opportunities. And missed opportunities lead to frustration, revenge trades, and losses. But here's the truth. Confidence isn't about ego. It's about evidence. The reason institutional traders act decisively isn't because they're fearless. It's because they're armed with data. They know what they're looking for. They wait for confirmation. And when they get it, they move. The three indicators we've covered today are your way of building that same evidence-based confidence. When you understand why a flag is forming, where smart money is positioning, how the trend structure looks, and when momentum is returning, you're no longer guessing. You're making informed, high-probability decisions, and that transforms not just your results, but your mindset. Final thoughts. Mastering the art of waiting. Trading, at its core, is a waiting game. Most traders lose not because they act too slowly, but because they act too quickly. They see a setup and jump in without confirmation. They chase moves that aren't ready. They act on emotion instead of logic. The best traders? They wait. They wait for alignment. They wait for confirmation. They wait for the market to tip its hand. And when it does, they strike with precision. That's the power of these three indicators. They don't just help you spot flags. They help you wait for the right flags. They turn indecision into patience and patience into profit. And once you start trading this way, you'll notice something remarkable. The noise fades. The fear quiets. The charts make more sense. And you start trading not like a gambler, but like a strategist. So the next time you find yourself staring at a flag setup frozen with uncertainty, remember this. Clarity isn't found in more screens, or more news, or more opinions. It's found in simplicity, in focusing on what matters. Use your volume profile to see where the big players are. Use your moving averages to confirm the trend. Use your RSI to gauge momentum. And when they all point in the same direction, that's your signal. Because at the end of the day, successful trading isn't about predicting the future. It's about stacking the odds in your favor, one decision, one indicator, one trade at a time. Now, the choice is yours. You can keep hesitating, second-guessing, watching opportunities slip away, or you can start using the tools at your disposal to trade with confidence and precision. The market rewards those who act with clarity and punishes those who act on impulse. Which trader will you be? Closing call to action. If this breakdown helped you see flag trading in a new light, make sure you hit that like button and subscribe for more deep dive strategy videos like this. And let me know in the comments, which of these three indicators are you going to start using first? Your answer might just help another trader overcome their hesitation too. Remember, clarity isn't luck, it's skill. And now, you have the tools to build it.